I am bullish on dollar assets. So if you can diversify into dollar assets, I think that's a good thing to do. So if you can buy property abroad with your remitted capital from here, legally remember, and if you can buy sort of overseas investments with that money, which are dollar denominated, again you will make money just on the currency. And if you're a local investor, I still think gold is a good bet for you. Even though on the dollar price of gold I'm very bearish. I see that going to like maybe 1350 thereabouts. But the rupee price of gold might be a very different kettle of fish because of the depreciation of the rupee, which almost inevitably happens when you have a weak market of the kind that I foresee.
You mentioned a point that it is time to align with defensive stocks. Define defensives for us.
Well, we've liked a stock called Tata Coffee, for instance. I'm just defining it. There are a few in the pack, and that's not a widely owned stock. But I'm just giving that as an example, that it is a company with an export edge. It benefits from a falling rupee. It is a Starbucks tire, which, I hear is doing very well.
You don't like the coffee there, do you? That's what you told me last time.
The coffee is absolute rubbish. But worldwide, I haven't had the coffee in India, but worldwide they serve trash coffee. And it's just 2,600 crore market cap, 17 times earnings, Tata Group company, so governance is not an issue, 21% return on equity. So in this scenario, again, coffee drinking is unlikely to sort of come down. That, in fact, probably because of higher stress, we end up drinking more, whether it is spirits or coffee, and if the rupee depreciates, they're a natural beneficiary of that. You have to find stocks like that, and interestingly, it has not fallen even a rupee in this entire mid-cap carnage. So I think $500 million market cap for a company of that size, a land bank of maybe 40,000 crores. Put it all together, that looks good. We like stocks like Nestle, we like stocks like Lupin, we like stocks like Sun Pharma. But that list is rather short. It's not a wide list of companies, unfortunately.
Any reason why you still like Sun Pharma? Because Sun Pharma has been a marked outperformer. It is up, more than 30% on a CAGR basis in the last 3 years.
Like I said, we are momentum people. We like stocks that go up and we hate stocks that go down. And remember, it's not about Sun Pharma, it's whether I find things better than Sun Pharma. Okay, so if I don't, then stick with the winner.
You've liked autos in the past, and we've had a conversation on why you like autos. But at a time when auto sales are slowing down, is it time to exit autos?
Well, we've been negative autos again for at least 2 months now.
Are you negative on Tata Motors as well?
Yes, very negative on Tata Motors. Because JLR has peaked in terms of what it can immediately deliver. Of course, it's still a long way to go by way of if you take a 2-year, 3-year view, but unfortunately markets doesn't work quite like that. And the domestic business is absolutely, bottom is falling out of that business. So all the good work on the JLR front is being gobbled up by the domestic side. And, our view is that Tata Motors is not a stock that should be significantly owned anymore. That view was from about 300, I think it's about 270 or 265 right now. I think there is more downside than upside on the stock. And remember, I've always said that I don't get emotional about stocks. Okay, so I've loved it for 3 years. I don't love it anymore.
Are you emotional about United Spirits?
Not at all.
You think the low-hanging fruits have been plucked?
Oh, absolutely, absolutely.
Even because of the Diageo makeover, even despite the Diageo makeover?
Yes, for a reasonable time to come, a lot of the sort of good news is in the price. But again, for lack of other good alternatives, it's still not a bad bet. So let me not make the case that it's an absolute roaring sell because you have an open offer at that price of 1440. It doesn't trade below that, I think just about 20% away. So within the context of what's available, it's still okay. But whether you're expecting it to go to 3,000 in a few months or even a year's time, I doubt if that's going to happen.
Well, last time when we interacted, you said tactically there is a trade in Reliance because it had fallen.
That's only from 820 to 880. That kind of trade, garden variety trade, you can find, every day of the week in the markets. But, we haven't liked the stock at all for many, many years. And we continue to believe that there's more downside than upside in the stock. It wouldn't surprise me if the stock traded at 700.
What about Bharti? Still a structural sell?
Absolute sell.
The entire telecom sector is looking slightly messy?
It has been messy from the time people realize that, look, the problem always happens, which is why I always caution people on banking, that when you have a sector wherein people are making a fistful of money for doing nothing particularly special, what was Bharti doing? What was Idea doing? What was Arcom doing? Or what was Vodafone doing? You're setting up telecom towers, Niku in Dalmia can set it up, boss. And now you don't even have to do that. You can outsource it, right? So all I need to do is focus my energy, get a license, and then it's a license to print money. It's just like banking, that I get a license which is free of cost. Strangely enough, I don't know why RBI should not auction the licenses. I've said this publicly, that it was such a 2G scam wherein we sold licenses so-called for cheap. Then why not issue bank licenses, also at a price, make an auction, because anybody who gets it is worth $1 billion on day one, right? So, telecom was that industry. People saw 40% EBITDA margins. They said, okay guys, why just 4 guys? Let's make it more democratic, which is the way it should be. The moment it became more democratic, the business is over. Banking is exactly the same. 4%, 4.5% NIMs, too fat here. Make 2%. So give 10 more guys more licenses. The trade is over for that sector.
So if liquidity influences the script of how Indian markets move for FY13, what really could influence the script for FY14?
The script will be a global equity market sell-off, significant, within which the high beta end of the market, which is unfortunately or fortunately where we belong, we will get hurt. We're already hurting. We'll get hurt more. And the backdrop to this will be a very, very inimical to equity investing global scenario, macro. India's macro already, as I mentioned, doesn't look too encouraging. Emerging market macro also looks terrible. China got downgraded, I think, today by Fitch, and they have said that the debt to GDP is extremely high, and which is, if you remember,
we discussed that in the past. Again, a wonderful call.
Exactly, about exactly a year back when we put out our China report, when people were still talking about 9.5% on China, and I said, and the report basically talked about that they hit the ceiling on the debt, 150-200% debt to GDP is not happening. So that's now what Fitch is saying, a year later. So look around yourself, it's not a pretty scenario. So I think the trade for 2013 is really speaking to keep your powder dry for a possibly good 2014. What
price point you think this market will offer value? I know you don't like to believe in value, but at what point in time should one use that dragon powder?
No, look, I mean, really, don't ask me about value, because I think it's in my dictionary of investing, it is a bad word. It's a dirty word. I just don't. Each time people talk about valuation on TV and all that, I start to cringe. Because what is valuation unless you can know what earnings the guy will deliver? And even if you do know what earnings the guy will deliver, you have no clue what multiple those earnings will get. So it is not enough for a company to deliver earnings. It's what we are after is what multiple will the market pay for that. And that you will only understand if you understand momentum, not if you understand value.
Since you're an excellent tape reader, what are internals suggesting?
Well, internals started to turn very bad from middle of January, and almost identical to what happened in February, March of 2000. A narrow group of stocks keeps making the indexes look good, while the broad market begins to hurt, and that's precisely what happened from January onwards. Now if you see, mid caps are not falling that much. At least in the last 3-4 days of fall, mid caps have held up reasonably well, because they have fallen a lot. But really the large caps, the Axis banks of the world, the SBIs, the UCO banks, all those guys are now getting hammered. So and that's anywhere where the ETF money is invested. I don't think they have too much money in IVRCL and GMR Industries anymore, but I think they still have lots of money in all these overowned stocks. So it's logical that the wheel will turn towards selling in the large caps. Mid caps, the
damage already has been done.
You can't even sell even for love or for money.
The space is already decimated.
Yeah, absolutely.
Somehow our today's conversation is reminding me of a conversation we had in 2008, where you were vocal and you were absolutely clear that markets, equities as an asset class was headed lower.
That was actually the beginning of the bear market. Whatever we have seen after that have been only large bear market rallies, if you were to think of it on a more philosophical basis, and I think globally also they have been in a bear market. But bear markets can look like bull markets. That's where the unwary are trapped.
Which is what we saw in 2012.
2012, we've seen it in 2013 when global markets are making highs. Makes you believe that everything is all fine. It's not that.